Hi, and welcome to this week's episode of the CostofCarry podcast. My name is James Chi. Let's get started. I was recently browsing one of the industry magazines and publications and came across an article about ASIC's Ep.628, which is looking for a mortgage, consumer experiences and expectations in getting a home loan, which was released in August 2019, so about a year ago today. Since the report was released, and obviously a lot has changed between now and then, and I thought it might be interesting to discuss and possibly reflect on some of the points that were brought up in the report. So like mentioned, this is available on ASIC's website, and it is the Ep.628. The first point that was raised was consumers expect brokers to find the best loan. As expected, and aligning with the best interest duty, which was coming in or being proposed at the time, not a surprise. But I do wonder if, as a broker, there is an instance where putting your needs or interests ahead of the client has ever worked. And I say that loosely because there are some cases of fraud and unethical behavior on behalf of brokers in the industry. I'm fully aware of that. But in terms of responsible lending and CPD, member bodies, aggregators and also lenders, I would think that not being able to justify a borrower's circumstances for a product would be quite difficult, not to mention unethical. That being said, as a broker myself, I think that much of the profession's job is about creating appropriate client outcomes. That's pretty much what underpins the industry, so that hopefully, as a result of the broker's work, they can maintain and hopefully prosper under the current borrowing situation. Whether it be through a fact find or a disclosure statement, the onus for broker-originated loans still remains with the broker in terms of justifying why certain features are more important than others, and that's instead of the broker justifying why each lender's policy is a certain way. Our job isn't so much determining credit policy, but rather working with our network of BDMs and mentors and peers to determine how the policy applies. And in doing so, we can find out if the lender's product is the best option for the customer. Second point, 60% of consumers take out a loan with a lender that they have an existing relationship with. This statistic has remained somewhere between the 50 to 60% range for the past couple of years, and I would imagine that it has to do with choice. Although most borrowers have an existing banking relationship with their bank, whether they were brought in through their parents or switched banks themselves, when dealing with an institution directly, consumers should only expect to be offered those products from that institution. Likewise, anywhere else they go direct to the lender, they will only receive those types of products. In some cases, going direct works. However, in those cases where lenders are calling up the loan, or perhaps it's an out-of-the-box scenario that requires some creativity, the broker is there to provide that assistance and guidance to the borrower in making the credit decision. Not only that, the broker isn't bound to any one institution and can search a whole variety of major Tier 1 and neobank lenders who can accommodate to a different variety or different profiles of borrowers. To add to that, I think part of the broker's attractiveness also comes from the fact that they are an intermediary where they can look after the handling of the loan and following up documents and valuations and assessments, and also explain provisions and also engage in the conversation to get not only the full picture of the scenario with the client, but also the whole lifestyle and group business structure as well. However, I think that the position of the broker is somewhat under threat, especially that 60% figure. As we saw with the purple bricks model in the real estate industry, there is significant events that are causing disintermediation, and especially in this period of public uncertainty, a lot of people are sticking with their banks in order to prevent any unnecessary stress. That's fair enough, but I'm not too sure that the sympathy or empathy is going to be there when it comes time to catch up payments or do annual reviews on affected property types. To add to that, that's the additional service that the broker offers. We fight on our customers' behalf, and we only get paid if we're successful. So it isn't as though that going through the broker channel you pay more. It's just that the broker is handling the process on your behalf. Third point, consumers who use brokers are different to those who go direct. Now, following on from the point above. So I've been in the industry now for just over a year, and I've seen my fair share of deals and customer types, and I mostly agree with this statement. Consumers who use brokers are ready to outsource the task to someone with professional knowledge, or who's getting professional knowledge, who trusts and sees value in the broker handling the intricacies of the process, and also appreciates having choice and being provided with the research that the broker does. On the other hand, consumers who go direct are looking for simplicity, and they want to be involved in all aspects of the process. Now, I'm sure there are many other characteristics for these consumers, but the reason why I think simplicity is somewhat misleading when going direct to the bank is that lending and finance isn't always straightforward, although nothing is always. In most cases, trying to organize and coordinate settlements, signatures, negotiating on loan terms, completing compliance and AML and KYC requirements, and also verifying and due diligence on the borrower. A lot of that is time consuming, and if you're not familiar with the process, it can be quite daunting and tiresome. Sometimes the banker will sort it out, but in most cases, the broker will be sorting it out if you go to them and trust them in sorting out your finance, because that's part of the package. They collate all your data or information and package it and put it into the appropriate fields in the servicing calculator and in the application form, and then they send it off. Interestingly, I should mention that it's probably not the best idea for a customer to come to a broker with the intention of them packaging it up and then saying that you want to go direct. Look, if you want to think about it in terms of that hangover meme, with the hangover movies, with the group projects, I mean, it's a classic, whereas like someone does 99% of the work, then someone comes in at the very beginning, contributes and disappears, and then comes back right at the end. Someone who says they're going to help but doesn't help, and someone who doesn't help at all and still takes the credit. So look, the broker doesn't mind helping. They want to help you in writing the loan. They don't want to just be in the administrative process of collecting the information. And sometimes in my experience, I found that my customers and who have trusted me doing it appreciate the work that I do in terms of drafting up the solution and, using my network to get them the best deal possible, because sometimes, deals aren't always available through the direct channel. But yeah, let me know if anyone has any stories or experiences about or similar to this where, they've had a customer come to them and, they've done the work and, then they've gone direct or they've gone somewhere else, or say, for example, they came over from the direct channel because they had a bad experience and now are fully sold on the broker value proposition. Item 4. How brokers present loan options is inconsistent. Now, unless processes or methods and automation is in place, inconsistencies are going to always be prevalent in the process, because it means that things are being done on a case-by-case basis. While this isn't bad in some aspects, such as workshopping and doing creating a natural tone to the conversation of workshopping and doing a fact find and doing servicing calculators, it can be problematic in areas such as justifying how products have been selected. So, for example, if all the options have different features, that's not going to be helpful. If the information collected and or the information that is used to workshop is inconsistent, then that's definitely not going to be helpful, because basically what's going to be happening is each lender will be getting a slightly different scenario, When these results come back to the client, these types of inconsistencies will make product comparisons and analysis difficult, because it isn't as though it's an apples to apples situation. It's more like apples to oranges to chocolate bars to bread. Each time something changes to a different lender, it's hard to evaluate the cost-benefit analysis or the appropriateness. As a minimum, it's good to have about 3 loan products. Obviously, it depends on the complexity and the options available to the borrower, but as a general rule, at least 3 is an adequate number. Point 5. Consumers have a mixed understanding of broker remuneration. Now, I can't speak for the industry as a whole, but remuneration usually comes in 2 ways for the industry. So through commission, which is upfront and trail, or as a mandate fee. For me personally, I make this aspect of the process known from the outset because I think it would save myself, and I also want to help the customer know what they're getting involved in. So having transparency between bankers, brokers, the customer and the lender in regards to remuneration is always going to make the process more straightforward and less complicated. Everyone's on the same page. Point 6. The importance of finding a good rate decreases throughout the mortgage journey. Now, I must admit, I didn't expect to find this one in here, but again, I agree with the finding. Finding a cheap rate or finding a good rate is important in the onboarding process, and usually for, say, first-time borrowers or for young borrowers, simply because in the onboarding phase, cost is usually the first priority for these types of borrowers. However, in cases where the lending is more complex, or when portfolio debt starts growing, this is where solution-based lending becomes more important and starts creeping into the picture. And to be fair, solution-based lending can be more important to rate-based lending. Not to say that they're mutually exclusive in all cases for all borrowers. Like, you can have a good cheap rate and also have a fantastic solution available. But look, we're talking about perfect in-the-box solution with no uncertainties, no question marks, no red flags, no nothing. But sometimes, look, getting the deal done is actually more important in saving that opportunity cost of time. For example, in development finance, like that's the one that just comes to mind, holding a property and waiting for the cheapest finance available can become very expensive, considering that the property has no utility, if that makes sense, in the meantime. Like, of course, it can be rented out until you demolish, but not only that, but you would be delaying demolition who knows how long. This can have flow-on effects for things such as cash flow and project turnover. So in the worst, like, just imagine, like, if you've demolished something and now you've purchased a vacant block of land, and now obviously there's nothing on it, but you're trying to finance now for the cheapest rate in the market. Would you rather wait and pay the outgoings and the interest and principal repayments, wait and refinance in, say, 6 months, or would you pay that slightly higher rate that helps the solution get done? Just for example, say it gets it done 6 months sooner. It's an interesting question. Like, obviously there's no right answer. It obviously depends on circumstance, but the longer projects go, they can get more expensive, and obviously you don't want to be paying more than you need. Lastly, point 7, 1 in 10 surveyed consumers struggle to meet their repayments. I can only imagine this number to increase in this environment, especially with the end of loan deferrals coming up soon, as well as other types of lender holiday period. Most lenders offer some form of restructuring service and are happy to help where possible, but there is only so much that they can accept or tolerate before their own books start moving in the wrong direction. A broker can assist in the refinance process because in most cases the bank will issue a call notice and let the customer figure it out And as harsh as that sounds, that's what happens. Broker can assist in this period, I suppose. They can help customers refinance and move to different lenders. It's just a matter of finding the right lender that's appropriate. If the lender is calling on the loan, a customer can go and visit, 2 or 6 or however many banks they want to see if they can help them. But if you do trust a broker and you do have a broker relationship, your broker should be able to help you. Not to say that they will or can, it's best to always go to the broker in that case, because in most cases, if there's an event such as this where the loan's being called upon, something else that's happened such as inability to service, change of circumstances, things like that. So the broker can get their head around the whole situation and then take that information to however many lenders and, save the customer that time of going one by one. On top of that, there's also talks of the government assistance, and not to mention that some forms of government assistance will also be ending. So I just think this problem will compound, especially for people who are unemployed in those infected industries and in those affected suburbs and areas, and especially those who hold property types as well. Most lenders have accommodated to that for the interim periods since they've been released, but we have to expect and be mindful and realistic that these things aren't forever lasting, they are finite. Maybe to finish on a lighter note, I think that doing your research or being aware of what's available so that if you do see a broker, you know what to expect, that is a good way to start. Also, being mindful of your expenses and also just keeping tabs on how your circumstances are changing and trying to be transparent within the household, I think is always a good couple of steps to make sure that everyone understands what's going on. Alright, and that concludes this episode of the Cost of Carry podcast. Thank you all for tuning in, and I'll see you in the next episode.